for staying around for the last paper. Thanks especially to the organizers for putting on a really great conference. I've learned so much, and in general, I really enjoy conferences that bring together regulators and academics and practitioners, because I feel like I just learn a lot. And thanks especially to Siddarth for agreeing to discuss the paper. This is joint work with Ben at Singapore, Zach Kowaleski at Notre Dame, and Alan at Hong Kong. Given the title of the paper, I thought I'd start out by just defining what RegTech is. So the way to think of RegTech is this is technology that improves the way that businesses manage regulatory compliance. A lot of applications, so this could be risk management, regulatory reporting, capital requirements, consumer protection. It can involve investing in entirely new technology, upgrading existing systems, or hiring people who are skilled in technology. To put some numbers on this, so RegTech is growing. It's quite a large area. So 2019, the last year that we were able to get numbers on this, U.S. firms spent $10 billion on RegTech investments and only $2 billion on auditing. RegTech expenditures are growing at 35% per year. And this is sort of an issue that's not going to go away, in the sense that technology is obviously evolving in what it can help firms do. And at the same time, there's not really any sign, any political hope of a major deregulation on the horizon. And then unless you think that we tried to coin this term for self-promotion reasons, I heard RegTech used during the panel last night, and then here's a quote here from Deloitte, which is one of the large audit firms. And so what we're going to do in the paper is we're going to ask how regulation affects technology adoption at financial institutions. And then the second part is going to trace this to operations and market structure. And we're going to look at the 2014 amendments that the SEC made to Rule 17a-5. This affects broker-dealers. I'll get into a little bit more detail as to what exactly the amendment related to, but the basic idea is this was addressed to deal with the Ponzi schemes and some of the issues around bankruptcies that were happening in the late 2000s. Essentially, the broker-dealers had to improve their internal controls. And I'll talk about exactly why technology was relevant to this amendment. We're going to assemble a data set that covers multiple aspects of technology adoption at these broker-dealer firms. So we have IT budgets, the number of hardware from Aberdeen. We also have the number of distinct software types from Aberdeen, technology-related hiring from data from Burning Glass, website technologies from BuiltWith. And then when we look at the operations of these firms, we're going to rely on BrokerCheck. And the neat thing about this particular data set is it covers not just the publicly held firms that get a lot of the attention in the literature, but also the privately held broker-dealers, both affected by the rule and unaffected. Okay, and so in terms of the findings, a little preview here, there's two effects on technology adoption. So there's a direct effect. So broker-dealers, they invest in enterprise resource planning, they add more computers and servers, they add software that specifically helps them with compliance. So in a way, this complements Sean's paper yesterday by showing that not only is technology adoption happening for endogenous reasons, firms are kind of endogenously responding to what's going on with their customers and what's going on in the economy, but there's a regulation motivation as well for adopting technology. Maybe the more novel part of the paper is to document an indirect effect on technology adoption. And the idea here is that data and information systems are shared across the organization. So if the compliance function improves digitizes data, improves the information systems, this is something that non-compliance functions can use as well. And so we document firms adopting customer relations management tools, business intelligence tools that leverage the investment that was made for compliance purposes. Okay. The second part of the paper is going to look at the operational effects of this. So we find fewer customer complaints at these broker-dealers, particularly the type of complaints in exactly the branches that you would expect with an improvement in the technological monitoring environment. And then we're going to do some what I'd call exploratory analysis of labor market concentration. Essentially, there's a lot of interest and a lot of concern about big data, about market concentration. And so we're essentially going to show an increase in labor market concentration. So let me tell you a little bit more about the setting here. So the way to think of a broker-dealer is they're a key intermediary between households and firms. Okay, so they help households access financial markets. They're really crucial to maintaining trust in the financial system. So the complaints that we're going to study later are relevant not only for their own sake, but just to the overall amount of participation in the financial system. There are two types of broker-dealers, okay? And the two types are going to be quite important for the way we do the empirical analysis. There are what's called carrying broker-dealers. They retain custody of the customer's assets and securities, okay? So they have a custodial function that's basically a back office function. And then there's non-carrying broker-dealers that essentially provide the exact same transaction services, provide the exact same financial advice, but don't have this back office function. Okay, and so the rule that we're going to look at affects the carrying BDs, but not the non-carrying ones. For the purposes of the customer interactions that we study, these are pretty much identical type firms. Okay, so the customers don't really know about the back office function. Now, onto the amendment. So I mentioned this is intended to address the Ponzi schemes that happened a little bit more than a dozen years ago. So with a Ponzi scheme, the firm is taking assets of customer A to pay off customer B. Maybe the firm is using the customer's assets to settle their own liabilities themselves. In the case of MF Global, when they were facing margin calls, they were posting customers' assets as collateral as opposed to their own. So this is something the SEC really was concerned about. They wanted broker-dealer firms to address. They came up with this amendment, which came into effect in June of 2014. And there are a few components of this amendment. So one is that you have to segregate customer assets from each other. So you can't commingle customer A and customer B's assets. You can't commingle customers' assets with the firm's assets. And you have to have the right amount of regulatory capital. And what's sort of distinct here from banks and insurance companies that I know many people in the room study is that you had to demonstrate that this asset segregation and the right amount of capital was had not only at the end of the quarter or the end of the year, but on a moment-to-moment basis. Every instant during the reporting period, this had to be true. And you had to have, not an auditor whose office is like next to a bowling alley, but like a PCOB registered auditor sign off and say that you actually had controls in place to do this, okay? A bit of institutional detail here. So here's some quotes from the audit firms talking about this amendment. So Deloitte is saying before the amendment, many of these firms used systems and technology that have been built in-house many years ago. This made it hard for them to demonstrate to regulators and auditors that they had the right report parameters and logic details. Ernst & Young or EY is saying after the amendment, these firms invested in shoring up their technology and data architecture, increasing the accuracy and completeness of source data. So in terms of thinking about over the last 10 or 15 years, there's obviously been a lot of new financial regulations. We haven't found any other regulation that so overtly discusses technology in this way. So we think this is a really cool setting for studying RegTech. And then on top of this, we actually have control firms. So the challenge always with studying regulation is that many times the regulation affects all firms in the market, whereas here we have some firms that are affected and some firms that are unaffected. In terms of the design, we're going to use a generalized difference in difference. Our outcome variable is going to be various measures of technology adoption. So the choice to have certain software types, the amount of hardware investments you have, labor demand relevant to technology, and then customer complaints. We will have fixed effects for each individual firm and each basically location by year to control for variation in enforcement, variation in economic conditions. We'll use all the standard controls that are common in this literature on broker-dealers. And so the first result on the direct effect of technology adoption, we find these broker-dealers, the ones that are affected by the amendment, they expand the number of data management programs they have by 12%. They increase their ERP software by 10%. There's actually a lot of extensive margin action going on here. So there's basically a 5% increase in the firms that go from having 0 ERP programs to having some amount of ERP. Those of you with an IT background know that an ERP implementation is like one of the major things that a firm ever does in its life. Okay, so this is to say this has a really significant effect on the technological capabilities of the firm. In terms of hardware, 44% increase in servers, 24% increase in PCs and laptops, and then the IT budget goes up by 63%. Not only is this sort of a technology response in terms of the investment, but there's also a labor response here. And I think this sort of complements my colleague Duran Asimoglu's work that talks about how technological innovation doesn't necessarily have to destroy jobs, it can also create new ones. And that's sort of what we're seeing here is that the firms that are affected by this amendment that we're studying, they increase the number of job postings referencing compliance and referencing ERP, or enterprise resource planning, which is sort of the main compliance tool that we're looking at here. Okay, we look at this in event time. So because we're using different data sets, we can't study each individually. We're going to basically create a dummy variable for the firms that have a high sort of technological capability with respect to ERP and some of the other programs that we talk about. Before the amendment, the control firms and the treated firms look pretty similar. And then you can see after the amendment, it sort of takes off. Okay, so that's the direct channel of technology adoption. Now, let me give you an example that I think motivates the indirect channel here. This is an example customer relations management software program. And so you can see here, it tracks the customer's portfolio. It says what assets they're in. It talks about the risk tolerance. It records all of the communications between the advisor and the customer. Now, who wouldn't want this, right? You can imagine, what type of broker-dealer wouldn't want this? The problem is going to be you can't have a tool like this if all you have is paper records, okay? Or if all of your records are in Excel and the Excel files aren't linked and updated, okay? And so the idea here is that a customer relations management tool or a business intelligence tool can provide value to a broker-dealer, but it requires you having sophisticated information systems in the first place. And so you're probably not going to do, say, a major ERP project just for the sake of adopting a tool like this. But if the regulation forces you to do ERP, well, all of a sudden that changes the NPV decision, okay? And the intuition behind this is that data and information systems are a non-rival risk good, okay? Let's think of what a rival risk good is. If a firm invests in a forklift, only one division of the firm can use the forklift at the same time, okay? Likewise, if a firm, let's say they hire a financial expert, which is a really common thing with securities rules, well, he or she can only be in one meeting at a time and performing one task at a time. But with data, it's non-rival risk. Multiple functions of the firm can use the data and use the information systems at the same time, okay? So this is why we would expect adoption of customer relations management tools. Same thing with website technologies. So there's been a huge innovation over the last few years in the types of technologies that financial institutions are using on their websites. So there's fraud detection, transaction security, live chat. You're not going to do this if you don't have good customer records in the first place, right? Your customers are not going to go to your website if there's no way for them to log into their account and get sort of the most recent information. And so the idea here, the overall idea is that regulation is compelling a broad improvement in the firm's information environment that then allows adoption of these complementary tools, okay? And this is exactly what we find empirically. So there's around a 13–14% increase in customer relations, the number of unique customer relations management software programs, the number of business intelligence software programs that the firm has. And then in terms of website technologies, we also find a significant increase. The results are especially strong for the firms that make more of the fundamental RegTech investments in the first place. So it's just kind of establishing that this isn't just happening at the same time, it's happening because of the compliance investment that's going on. Now, a natural concern with a paper like this is that we're just picking up a broad investment that's going on. The firms are just kind of improving their IT overall for reasons that are completely unrelated to regulation. And so we're going to do a couple placebo tests. We'll look at antivirus software. Okay, so this isn't very clearly related to the amendment or to customer relations management. And then we'll form sort of a group that's the complement of all the other software types we study. We find no increase in those software types. Okay, so it does seem to be related to the amendment, this expansion that we're documenting. Okay, so then the second half of the paper is going to look at the operational consequences of this. And again, the idea is that firms, when they make an investment for compliance reasons, they can also use the outputs of this for operation reasons. Here's a Thomson Reuters survey from a couple of years ago. It asked firms, how are you using the outputs of your RegTech investments? And so right here, so this response here, it is only used by risk and compliance. So only 19% of financial institutions said that our RegTech investments are purely for compliance purposes. They have no strategic or operational use. The other 81%, in various degrees of importance, say that they are using it for operational purposes. The orange bar, which is missing here, is the globally systemically important financial institutions. All of them say that they use the RegTech outputs for operating reasons. Now, the particular operation focus that we're going to have here is we're going to look at customer complaints. Here are a couple of quotes. So one's from FINRA. FINRA is the main regulator of broker-dealers. They talk about how there are now software tools that allow broker-dealers to reduce the number of false alerts, improve cost efficiencies, improve productivity, and focus their risk management activities on heightened areas of risk. Okay, so the idea is that these customer relations management tools that I showed you in the last table could reduce complaints. Behavox is one of the largest RegTech vendors in the US. They pitch themselves by saying our software helps you identify bad actors, so in other words, bad advisors really quickly, preventing massive fines and company debilitating crises. So our results are in line with this. We find a 2% decline in the likelihood of having a complaint, around a 3.5% decline in the number of complaints at the broker-dealer firm that year. If you look at event time, these differences are not found in the pre-period, it's only in the post-period, and it's only about a year after. Because the idea here is that if you do a major ERP or data management project, it takes a long time to do the implementation. So it made sense to us that the results showed up a little bit with a little bit of a lag. Economically, these are non-trivial results in the literature on customer complaints and financial participation through broker-dealers. So 29% decline in damages, 3.5% decline in the number of complaints. Compared to other regulatory and individual factors studied in this literature, these are sort of non-trivial results. All right. Now, this is not only just happening at the same time as the regulation, it appears to be happening through the technological investments that we study. So we're going to do an IV, which uses as an instrument a dummy variable for whether the firm made a high or low technological investment. The firms that make a bigger investment in technology in response to the rule experience a bigger decline in complaints. Okay, and then in the interest of time, I'm not going to go through in detail all the other cross-sectional tests we do, but the particular pattern of complaints that we document is not sort of uniform. It's happening at non-headquarters branches. So the further away branches that are harder to monitor, where you think an improvement in the information environment and an improvement in monitoring would result in fewer complaints. We'll do textual analysis on the type of complaints. The type of complaints that are more easy to detect using technology and screening, those are the ones where we find the decline. We find the decline when it's a senior officer who's putting his or her signature on the financial statements and saying that, yes, we attest that this is true, we attest that we have these controls. Senior officers are going to have the ability to direct these types of investments, and they have greater reputation concerns. And then, there are some financial institutions that were really high on compliance before this amendment. It's like they didn't need the amendment to improve their controls. We don't really find results for them. All the results seem to be coming from the firms that started from a point where they had very low technological capabilities, and then they improved them a lot. In terms of robustness, so a natural concern with a paper like this is, okay, what are the differences between the carrying and non-carrying, or the treated and control, that could explain this pattern? We're going to do a coarse and exact matching analysis. We're going to control for size and product differences in all sorts of ways. Basically, we're going to find the results are the same. So this doesn't seem to be a manifestation of just business model differences between the treated and control firms. Now, take a step back and think about what's sort of going on here. Wouldn't every broker-dealer want to have a decline in complaints? Like these regulatory complaints, they have reputation costs. They obviously have a lot of fines and sanctions. What is the trade-off here? So our results suggest that the complaint decline is worth about $60,000 for the typical firm. You compare that to doing an ERP implementation, it's many, many orders of magnitude greater. And so I think the way that we're showing this trade-off here, it supports the complementary explanation that we're offering here, the indirect channel that we have in mind. It's that the broker-dealer wouldn't adopt ERP just for the sake of getting a $60,000 savings on the decline. But if you force them to do ERP in order to participate in the market, well, all of a sudden that implementation cost is fixed, okay? And so we think that the way that these numbers work, it sort of supports the complementarity interpretation. The very last test, and again, these are more kind of exploratory, look at concentration. Again, these are sort of motivated by Philip Hahn's work on some of his theory work on concentration and big data. So there's a few ingredients to the test here. One is that fixed costs are just naturally easier to bear for larger competitors. And the SEC comment letters about this particular amendment mentioned this many, many times. And we have some quotes in the paper that basically the small firms were saying, this isn't fair. It's easier for bigger firms to comply here because there's a fixed cost of the technological investment. From a theoretical perspective, we have evidence that larger financial institutions tend to thrive on hard information. So regulation that sort of pushes more hard information on them, well, large financial institutions will know what to do with it. And then there's obviously economies of scale with respect to the benefits that we're documenting here. Data is going to be more valuable to the larger financial institutions because there's more cross-selling. They're going to be able to develop sharper models. And then we have an interesting quote here from one of the industry publications in the broker-dealer space. They talk about how scale helps firms increase their fixed investments. They support a greater number of advisors. And this is actually, technology is actually a big driver of why an individual chooses to work for a given firm. And so basically, we're going to test who is switching from what firm to join another one. And after the amendment, essentially, you see more employees leaving the control firms or the untreated firms and joining the treated firms or the regulated firms, okay? And this is especially true with employees leaving small firms to join big ones, Okay, so this is sort of micro level evidence supporting the idea that this is going to increase the optimal size of the firm, okay, and increase market concentration. And indeed, this is what we find. So the very last test is, again, somewhat descriptive, but we think that the micro evidence is useful to inform this. So we find an increase in the Herfindahl index with respect to the headcount at firms in a given MSA year. The concentration ratio, so the market share or the employee share of the 4 largest firms and the 8 largest firms also grows as well. So let me wrap up a couple minutes early. So a few things. So regulation compels technology adoption. There's a direct effect. So you see investment in ERP and digitization, data management that's directly aimed at addressing compliance. Okay, but this then spurs the indirect effect that because the firm improves its overall information environment, generates new data, other functions of the firm are able to use that. Okay, and that's because of the non-rivalrous feature of data. Okay, so we see a non-trivial increase in the number of CRM programs, business intelligence software programs, an improvement in the technologies that the firm has on their website. This then has operational effects. So there's fewer customer complaints filed with the regulator, lower alleged damages, more labor market concentration, okay? And then a few potential implications of these findings. One is that, as non-compliance functions start digitizing data and doing more analytics, then what happens to compliance is going to have an obvious effect on the non-compliance function. Okay, so as technology advances and regulation relies more and more on technology, you're going to see a greater linkage between these two functions. The second is that I think we're the first to show a role for technology in investor protection. So we find, these complaints are really harmful to investors. A lot of people, when they experience them, they stop participating in the stock market. We're showing that technology can reduce those types of complaints that are costly to our economy. And then this is, maybe more speculative and for future work, given the fixed costs of technology-based compliance, it tends to favor larger financial institutions. And this can worsen some of the concentration issues that people have been talking about. So that's all I had. Thank you very much for your attention, and I look forward to the discussants.
All right. Thank you. Thank you to the organizers for asking me to discuss this paper. It was a lot of fun to read. And interestingly, when I was watching the Super Bowl last Sunday, there was an ad that stuck out to me because I just read, I'd read the paper and sort of had this idea of complementary investment sort of in my mind. There's this ad that sort of stuck out, and since it's the last discussion, etc., I might as well just play the ad. So this is an ad by. We'll talk about it.
Never lose confidence in how you run your business. Intuit is bringing QuickBooks and MailChimp together to help you set up and grow. New business? No problem. And I love this set.
All right, so as the punchline of the ad is that your books and marketing together at last. Last year, Intuit bought MailChimp, which is sort of an Atlanta-based company, and sort of putting this sort of accounting-based technology together with this marketing-based technology is just sort of essentially the idea in this paper, except that the technology sort of is driven by regulation. So the question this paper asks is, does and how does regulation-driven technology adoption, which the authors call RegTech, or everyone calls RegTech, affect firm operations and market structure? And the context that we're going to look at here is US broker-dealers. So basically people who provide investment advice, execute trades, etc. for their clients. The imperative strategy they're going to use is this 2014 SEC rule change that increased compliance burden on carrying broker-dealers. So broker-dealers that actually take custody of customer assets, called carrying broker-dealers. They're going to do sort of a standard diff and diff around this rule change, comparing carrying broker-dealers to non-carrying broker-dealers, those who don't take custody of their customers' assets. And they're going to find sort of, I think, 4 sets of results. There's sort of the direct effect on RegTech. So there's this increased IT spend and compliance. There's this sort of indirect effect on customer relationship management software, when it comes to firm operations, there's a decline in customer complaints. And there's some stuff at the end of the paper about what happens to market structure. We see a labor shift from non-carrying to carrying broker-dealers. Right? So I think Andrew went through the results quite nicely. In figures, these are sort of the 2 major results in the paper. There's an increase in investment in RegTech, and that leads, the authors argue, to a decline in customer complaints. Right? So the red line is the law change, the rule change. You can see sort of very nice diff and diff graphs here. That's essentially what the paper is. And my overall impression is that this is a very, very nice paper. It was really nice to read. I think it makes a very clear contribution. And it's also nice to sort of get a peek under the hood of compliance costs. So it has a lot of detail on what are the kinds of technologies that are being used for compliance in the broker-dealer industry, et cetera. And they put some numbers as to how much they cost, et cetera. So I found sort of that part of it very, very, very nice. It's carefully executed. There is a ton of very impressive data work, a lot of manual matching to put together multiple data sources. So my main comments are going to be, first sort of around the diff and diff itself, the empirics. Then I'll talk a bit more about sort of the mechanism of the complementary investment, and then finally on the results on concentration. So this is a diff and diff paper, sort of paper using the policy change to identify causal effects. Kind of the bad news is that the treatment is based on a discrete characteristic, right? That you're either carrying or you're non-carrying. It's not one of those where there's an asset threshold and there's some people who are just above the asset threshold and some people just below the asset threshold. So it's not a continuous characteristic, it's a discrete characteristic. And you can see this is one graph in the paper which sort of shows that the treated broker-dealers, who form about 5% of the sample firms, are just very, very different from the non-treated broker-dealers. These are just, the carrying broker-dealers are just much, much larger than, I think the median carrying broker-dealer is about 100 times larger than the median non-carrying broker-dealer. They do sort of a matching analysis. I think that's not a complete panacea. I have a lot of sympathy for the authors here. I think it's hard to sort of get around this. But the good news is that the pre-trends look good, right? So it doesn't seem like there's anything going on that affects tech investment around that time on carrying versus non-carrying broker-dealers. A question I'm sort of interested in is, do broker-dealers switch their type following the regulation? And actually that would go, if they do, that would sort of go in the selection effect sort of counts against the author. So that but it would be interesting to note, because there is literature talking about how banks have tried to avoid regulation by slowing asset growth. So do carrying broker-dealers become non-carrying broker-dealers because they, The other sort of slight concern I had with the empirics is the dynamics of the treatment effects. So the rules themselves were notified in 2013, came into effect in 2014. And the 1-year period is essentially for that implementation lag, right? To give firms time to sort of put this stuff in place. But what I see in sort of this investment is that it keeps on growing, right? So there's an increase in 2015. The big spike is in 2016. There's a bit of a spike in 2017. Implementation lags might be what's driving this. But I don't know. And so I think one thing Andrew mentioned also in this presentation, there's some firms which start from scratch, some firms which have a lot of stuff already. do the firms which have high pre-existing tech see the jumps in 2015? Is it the ones who have to start from scratch, who take a longer time? I sort of did a cursory search myself of sort of stuff happening in the broker-dealer industry around that time period. I couldn't find, it's cursory, but I couldn't find anything that would sort of explain these results. So, having got through that, I actually sort of believe the results, but these are sort of the standard, the standard things that will come up. Let's get into some of the mechanisms the paper is talking about. So this is kind of the causal chain that the paper has in mind from my reading. But you have this SEC rule that leads to this increase in RegTech, which leads to an increase in customer relationship management tech, which leads to a decline in complaints. And I think the authors do a lot around what's happening with complaints. So I'm not going to focus much on that. I'm going to focus on this link, which I think is sort of the cool part of this paper, which is this link from RegTech to this customer tech or CRM tech. The paper motivates this because by saying that RegTech generates data, which is a non-rival risk good, and just this generation of data allows the company to invest in CRM. This is actually a very nice, this is a very nice result, or it's a very nice channel. But there are other things that could be going on here, right? Well, one is that it's not the firm which is making that decision, it's that the suppliers of the RegTech are also bundling CRM tech along with RegTech. That's exactly what Intuit is doing, right? That's coming from Intuit, that they're saying, okay, we'll give you MailChimp with QuickBooks, right? And so they have data on who the suppliers of these technologies are, who the vendors are. I think they could test this very easily. Is there overlap between who you get your RegTech from and who you get your CRM tech from? There's also a result that RegTech leads to hiring of IT personnel, right? And are these IT personnel the ones who are pushing the company to employ new technologies? Maybe the company, some of these broker dealers have no idea that they could do some of this stuff, and they hire these people to implement their RegTech, and those people say, okay, we'll implement your, you can implement CRM tech as well. I think none of these are mutually, none of these are mutually exclusive. And I think none of them, whatever it is, it sort of doesn't take away from the sort of the major message of the paper as to the sort of complementary investment. But I think it would be nice if we had a better sense of what's driving the complementary investment. The other mechanism is that there is just RegTech itself leads to the decline in complaints. It's not because of this CRM tech that's being introduced, right? So these rules were put in place as a reaction to large-scale frauds, Madoff, etc. And so there are some guidelines of providing regular statements to consumers. There's some increased monitoring of employee actions. There is an IV analysis that tries to isolate this, but it mixes the RegTech and the consumer tech. It might be nice to just see what happens if you just throw the consumer tech as the instrumented variable. Right. Finally, I want to speak a little bit about the market structure effects, which are also very interesting. So, the common concern with compliance requirements is there is this higher relative burden on smaller affected firms, right? So smaller banks will find it harder than larger banks. A 12 billion bank will find it harder than a 40 billion bank, right? And so that could potentially lead to increased concentration in the market. And one of the ways that concentration could manifest itself is that broker-dealers merge with each other, particularly smaller carrying broker-dealers. And I was a bit surprised that the paper sort of didn't go down this path when it talked about market structure, right? That what happens to M&A activity, etc. What the paper does is it looks at labor market concentration. And here too, it sort of makes very nice argument with some sort of anecdotal evidence that these advisors are moving from non-carrying to carrying BDs. So from the ones who are unaffected to the ones who are bearing the compliance costs. And the reason is that they're attracted by firms which have good technology, right? That is the argument sort of anecdotally, is that these carrying BDs, even though they now have this higher compliance cost, they are able to attract people from non-carrying BDs because they have this technology. That these guys, these advisors want to work there. But then that creates another possibility as to why the complaints are coming down. You're hiring guys from non-carrying BDs. You're hiring them probably because you think they're good advisors. Maybe the technology changes your pool of employees. And that is what is driving the decline in complaints. And in a relationship-based business like broker-dealers, that would be something that's probably very important if you're sort of becoming the tech. And again, I think this does not sort of detract from the message of the paper. It's sort of, again, something that the technology is sort of leading you to, but it has the source is sort of the labor market effects, right? So I'm sort of done. So as I said, this is a very interesting paper on regulation-driven technology adoption, its knock-on effects. A lot of nice data gathering, careful execution. And I think the takeaways from the paper could be sharpened with just a few sort of simple tweaks on mechanisms and concentrations. But I think the paper is very interesting.